Good day. My name's Graham Elgee, and I'm going to be talking you through the presentation on AMT for contractors, or more specifically, the contractors module within AMT. Now, when we refer to contractors, this also means rental, or sometimes referred to as plant hire. It's all the same base module within AMT. The objective of this presentation is to give you an overview of the concepts and methodologies in AMT in respect to the contractors module. It's not to give you a detailed training on AMT. Coming out of this, you won't be a trained user. This presentation is really meant as a precursor to your training, so that first of all you understand some of the base concepts, the underlying principles that we're applying, so that when you do have the training, you understand how the program's working in the background. It does assume that you are familiar with the core maintenance processes within AMT. So by that I mean you're familiar with how to set up equipment, projections being made up of strategy tasks. You're familiar with the structure of a strategy task, long-term planning, the short-term planning, and particularly work orders, the concept of work orders, how we capture actual costs on work orders, and how AMT is also performing the life cycle costing, forecasting what's going to be happening in the future. So that's really the starting point. Is really what we're looking at here is how does the contractors module overlay the base maintenance functionality within AMT. So the contents, we're just really going to be looking at specific concepts or methodologies or principles within the program. It's not really in any specific order. It's not as though we're going to be going through a sequence. These are the 6 or 7 key sort of bullet points that or areas that we feel you should understand before starting on any training around the actual AMT functionality. So the first point is AMT, this module, it is designed for plant groups. And what do I mean by that? What I mean is the structure of a lot of contractors, say particularly mine contractors, is that there's a central plant group that manages the equipment. They're the owners of the equipment, as it were, within an organization. And they hire out the equipment internally to projects. So those projects are still internal within the company. It's a project the company's got to maybe do some earth moving works. And that project is the entity within the companies that is actually charging your customers. For that project, some of their costs is the hire of equipment from the internal plant group. And other costs are the direct costs that they incur. So if we look at this structure, we have the central plant group. They're the ones who are maintaining the equipment. They're the ones that are paying for the general maintenance, the services, the major components, and also the ownership costs, the depreciation, the finance on the equipment. And they hire out the equipment to the project. So the projects pay a monthly hire invoice to the plant group. So the objective of the plant group is to be as efficient as possible with managing the equipment and allocating the equipment. They're responsible for ensuring that the equipment is utilized within the organization. So they are looking after this broader pool of assets. And they might hire out an asset, a dump truck, to a project for 12 months to one project, and then it might sit idle for 3 months and then be charged to another project for 2 years. That's the role of the plant group, is to be hiring the equipment out to the projects. The projects would also incur other costs, other direct labor costs, general expenses and things. And then their objective is they sum up all their costs and they invoice the customer, and they're charged with making a margin. So the AMT module is designed for the plant group, for this group here. AMT is not, in this situation, designed for the project group. We do have a separate module of AMT that is more aimed at, say, the OEMs having maintenance contracts that has project type functionality. But in the context of this presentation, everything that we're going to look at is really through the lens of the plant group. It's the plant group and how they balance their revenue that they're getting in from what they're hiring the equipment out against what their costs are. So some of the features at a really high level is equipment are assigned to projects. Now this screen's probably a little bit too small, but the main sort of takeaway points is a machine can be assigned to many projects over its life. It can't be assigned to more than one project at any given point in time, but it can be 3 months on one project, 6 months on another project. So within this screen we've got which project it's been assigned to, a start and an end date, and then there's a plant rate structure where and that is made up of many different plant rate categories, which we'll talk about in a minute. There's a certain element of scheduling of equipment where it's under projects right now, or it could be assigned to future projects. Some of those future projects might have a probability assigned to them, meaning you might say it's a 60% chance of that project happening. And that color on this Gantt chart indicates the different levels of probability. Probably the main report that summarizes this is we produce a P&L for the plant group, and that can be looked at in a number of different ways by equipment, or can actually be looked at in the context of a project or a specific site. But the main fundamentals is that the plant group is receiving revenue. This is its high income that it's receiving, this revenue section. And then it's got a cost section where it's got its costs incurred. Now this report isn't a very good example because we've only got a couple of costs on it. Normally you'd expect to see many different cost categories. In fact, you'd expect to see cost categories matching the revenue categories. Now we'll go through this P&L a little bit in the future, but at this point the main takeaway point is just there's the concept of the plant group's got revenue and it's got costs, and it's really some organizations, the plant group is charged with really breaking even, just coming up with really competitive plant rates and breaking even. Sometimes the plant group is charged with making a margin, but either way it's got the concept of revenue versus costs. The second aspect is that AMT should be capturing and forecasting all costs. And by that I mean not just your maintenance costs, which is probably what you're familiar with, but also all your ownership costs, your finance, your insurances, your depreciation, and also your overheads, any indirect costs. Your plant group have an overhead structure. It's got your managers and certain administrative staff. Those costs should be factored into your plant rates. So another way of looking at this is any cost that the plant rates, your plant invoicing is designed to recover, you want to have those actual costs being captured in AMT. So that when you are looking at reports that show revenue versus costs, you're looking at an apples with apples comparison. So it is really important to make sure that when you structure your setup of your costs, it aligns to the setup of how you're going to be charging the invoicing or the revenue for that asset. What you don't want to have is that you've got $100 worth of revenue coming in and that covers, say, depreciation, but then you're comparing it with costs which might only show $70 because it doesn't have depreciation. It makes it difficult to look at those reports in a meaningful way. So AMT is designed to have all costs that essentially are incorporated into your plant rates structured within AMT. To assist in that process, we set up all these costs as strategy tasks. Now, the strategy tasks that you've seen to date are probably the ones that are really geared for maintenance. It's got all the maintenance type fields. It's quite a complex series of forms. There's a lot of maintenance detail that you can record in it. So we've set up a specific type of strategy task called a capital strategy task. And this allows you to, first of all, enter your base capital parameters. The capital cost, the expected life, the residual value you're working towards, your finance rate as a percentage, your insurance rate as a percentage, your expected utilization of the asset. And from that base information, AMT will then calculate what your rate should be for depreciation, insurance, and finance. Now, for each one of these areas in the section below, you can come and assign specific coding, but you can also decide to override the calculated amount. Hopefully you won't want to, but if you did want to override the calculated amount, you could override it. You can also define how you want the scheduling or the invoicing of, the scheduling of that cost. Is it a fixed monthly amount, in which case you'd check this area, or is it based on usage? Is it going to be a rate per engine hour, which is in this example what's checked below. So you've got the option to set it as a usage-based cost or a fixed monthly amount. The other category that we've taken a similar approach to is what we call other operating costs. And these are typically non-maintenance costs, but they're still costs that are being incorporated into your plant rates that you want to set up as strategy tasks. But because they're not maintenance, they're a lot simpler in their structure. You don't want to overwhelm the user with a lot of detail. So it just provides a much simpler format for the user to set these up. So a typical example would be the recovery of the plant group overheads, where you just want to set it up, and you want to set it up as either a fixed monthly amount or a rate per engine hour. So those two forms, they actually populate the same structure underneath within the database of AMT. So the program still works in the same way regarding those cost items. It just provides a more appropriate user interface to be setting up, first of all, your capital costs and also your other operating costs. The next item is what we've termed aligning your revenue with your costs. Now, we've touched on this a little bit, but the key principle here is that you want to be able to compare your revenue for an asset against its costs and be able to drill down on that. You don't just want to have one number that says the revenue for a truck was X and the costs were Y, and then you've got no ability to really understand where is the variance. So plant rates, when you set them up, have a structure. They've got sort of plant rate categories. And each company will have its own structure for how you set those up. Typically it would be depreciation, finance, major components, consumables, maybe tires. So this is this section here. Now within AMT, the code that we use to define that structure or those categories is expense element. So the expense element code is a really important code within the whole contractors module within AMT. So it's what's used to set up your plant rate categories, but it's also then assigned to all of your costs in your strategy tasks. So this is an extract on the right here from a strategy task, and you'll see that for parts, labor, and miscellaneous, we can assign expense elements. And so it's the expense element that is the main joining field, if you put it that way, between your revenue and your costs. Now, when we bring in your actual costs from your accounting system, we might not have that code sitting in the accounting system. So if it is blank, AMT will automatically populate that expense element onto the work order that we bring in. And it looks at what strategy task that expense element align, or that work order aligns to, and assigns the expense element from that strategy task. So the good news is it's not critical that this expense element is actually set up or exists within your accounting system. It can be purely within AMT. And again, the expense element, each company will define what their categories are. But of all the system tables within AMT, for the operation of this module, this contractors module, the expense element is probably the most critical code to get correct, because that really defines the backbone for a lot of the reports and the analyses within AMT. I've got a couple of examples here. Again, apologies for the quality of the data, but you'll get the general idea. So in this report here, we've got an equipment at a certain project. It's got what the current rate is, what the revenue is, what the cost is, and what the variance. And these two columns here provide a summary. But then the rest of these columns, each column represents an expense element. And each one's got a code. So DP, that's probably depreciation, finance, insurance being the three ownership ones, fuel, maintenance, labor, maintenance parts, etc. Going across. So for each one of these expense element categories, we can see what is the current rate, what is the revenue to date, what are the costs to date, and what's the variance. Similarly, with this format of report, we've got each expense element listed down, what's been the cost, what's been the revenue, what's your under-over recovery. Again, both reports are giving very similar information and really just re-emphasizing the point that it's this expense element that gives us the granularity behind the revenue structure or the revenue stream, and allows us to compare the costs against that to give you your main under and over recovery. So other reports within AMT, you can look at your entire revenue and all your costs and say, well, let me analyze that variance. Are we, as a rule in the company, are we under or over recovering on our depreciation? Or is it our major components? Or is it our maintenance labor? Where are those variances? How accurate are our plant rates? And if they're not accurate, which is the area that we need to be focusing on? Okay, the next issue, this is probably the most complex issue and the most contentious issue, is accounting for components. So there are a couple of issues with components. They've got a high cost, and they performed maybe every 2 to 3 years, sometimes less, sometimes a bit more, but let's just say that they performed every sort of 3 years. So you've got a very sort of spiky cost. You have no cost, and then suddenly you have a massive big cost. Your plant revenue, however, for components is more of a consistent line. It's built into your plant rate. So even in the first year of operation, you'd be recovering or collecting monies in your plant revenue for your major components, even though you haven't incurred any costs. So this is what's illustrated on the chart below. The blue bars, that's your revenue. So that's your consistent revenue for each period. The red line, that's your cost each time you do a component. So I've got a component being performed every 5th period in this example. The green line is your accumulated profit and loss, as it were. So you start off earning $10, but you have no cost. And the next month you earn another $10 and no cost, so you go up to a cumulative 20, 30, 40. And then the last period you earn 10, but you incur 50. So you come back to a break even. and then you go through the same cycle again. So what this means is, in these first 4 periods, you're showing a profit which isn't really correct, because you know you've got this big cost coming at you down the line. And then in the 5th period, you're reporting a big loss, and that's also not correct. So it ends up with your P&L being very distorted, where you're either sort of showing a profit, or when you incur your major components, suddenly you're showing a big loss. So that's the one issue. The flip side of the coin on that, it's the same issue, just looking at it from an asset valuation, is assets don't really depreciate on a straight line basis. And to illustrate that, if you were valuing a haul truck that was 5 years old, but it was in need of a major overhaul. All of its components were pretty run down. So it was 5 years old, but in need of a whole lot of major components. Its value would be significantly less than a 5-year-old truck, same age, but it had just gone through a major overhaul and all the components were rebuilt. So there, the value of the 2 trucks is quite different, even though they've got the same age. And really, when you break that down, you could say, well, the base asset could be depreciated on a straight line basis, the frame, the cab, etc. But then its major components, you could actually depreciate on, or their value drops on a much shorter time frame. The engine its value would be expended over the life of that engine, and then you put a new engine in and the value would go up, and then you depreciate the next engine. So you could really separate your major components from your equipment. And the net result of that, if you added these 2 asset valuations together, would more be this blue line, darker blue line, which is zigzagging, which again, you are depreciating your engine. At this point, you put a new engine in, the value of your asset goes up. And you come down, you put another engine in, the value goes up again. So that's more of a realistic market valuation for your assets. So we've got these 2 issues, and they're both caused by the same thing. So there's 2 approaches within AMT for how we can handle this. What we find is companies do vary in their opinions between whether what we call component provisioning is acceptable, or whether component capitalization is the appropriate way to go. So we have built AMT with the flexibility to support both of those processes. And so it's really important that at the start of any AMT installation, companies nominate which approach they want to use, because we do configure AMT. There are some configuration settings to support the different approaches. The bulk of this presentation is around component provisioning. That's really the focus, and a couple of the later sections are really under the assumption that component provisioning is being applied. Component capitalization, there's just a couple of slides on it. It's really a whole another sort of module that gets added into AMT when we look at the full component capitalization. So let's just have a look at those 2. First of all, component provisioning. One point before I get on to component provisioning. We don't think that at the end of the day, we don't think that there's much of a difference between the 2 from your net output, as it were. We think both end up in pretty much the same place. There is a difference, I think, for tax, but it's again, it's a little bit of a swings and roundabouts, and just to illustrate that, from a tax point of view, you're allowed to claim depreciation, but you're not allowed to claim provisioning as a tax deduction. That's a very general rule without getting into too fine a sort of detail. So if you are going the component capitalization route, you are depreciating each component. So you would get this darker blue line as your tax valuation. If you're going the component provisioning, you're probably getting the green line, which is just depreciating the overall asset and getting that as your depreciation. Now, at the end of the day, you end up in pretty much the same point. Probably, though, in the first 2 to 3 years, is an advantage around the component capitalization. You get a more aggressive depreciation. But then as you get into the middle years, it starts to become a little bit of a swings and roundabouts. Sometimes you hit on one, sometimes you hit on the other, and then eventually towards the end, your sort of end point is going to be pretty much the same. That's probably the only material difference that we can see. So it is important to sort of just recognize as we jump into the detail of this, there's two completely different approaches, but they both, in our view, end up at a very similar point. Okay, so component provisioning, how does it work? Plant revenue for components that you're getting in. So if you're getting in $12 an hour for your major components, and that comes into your P&L as revenue, into your plant group as revenue, that is transferred out as effectively a depreciation, as a cost, to a provision account in the balance sheet. So in that situation where you have a brand new truck, you rent it out that first month, you're getting money in for your major components. Essentially what we're saying is don't take that as profit, put that money aside into a provision account. And as that provision account should then accumulate to the point that when you perform your component change out, that big lumpy cost that then hits your P&L, you can transfer that out of your P&L. You can credit your P&L and debit your provision account. And if you've achieved your target life for the component and it has the same repair costs as what you've been setting aside, there should be enough money, or it should match what is sitting in the provision account. So that's the basic structure of how the provisioning works. Now, there is the situation then that says, well, what happens if you don't achieve the life? If you've only got 100,000 in your provision balance, but you charge 150,000 for a component, you're going to have a negative 50,000. So to account for that, because you've got lots of hundreds of components being charged and entries each month for the revenue, AMT has a report that is calculating what you should have in your provision balance. So we've got a report that shows what is the actual provision versus what should be in your provision. And it's really something that we recommend companies keep a reconciliation on at a high level. You know, it's a little bit of a swings and roundabouts. You'll gain on some components, you'll lose on others. And where you see an imbalance, then you do a journal to correct that, where they start to get out of sync. We don't recommend that component by component you be working out that you made 3,000 on this one and lost 4,000 on that one, and you be journalizing adjustments at that level. It would more be at a region or a fleet level, where you're sort of looking at the sum of the components. But that's really a call for each company to make as to how much granularity, how much detail you want. In essence, you can just have one account in your balance sheet called provision account, and it's got a number, and AMT will give you the breakdown of that number by machine, by component. So it's got the full audit trail. It's just to what level are you also trying to make incremental adjustments within the accounting system. So now this component provisioning, it is also sometimes called a repair reserve. or a maintenance accrual sometimes. So there's a lot of different terminology used in this. Yeah, we'll stick to the terminology of component provisioning. So how does this look on your P&L? So you've still got your revenue and you've got your actual costs. These are your real costs. But then there's a section below that talks about CBD adjustments. So these are your component adjustments. And these are the journals that are going backwards and forwards to your balance sheet provision account. So for any particular asset over time, the sum of these journals will actually equal 0. Because really whatever you transfer to the provision, you're going to be reversing at some point. And eventually when you sell the equipment, you're going to clear your provision balance, any provision balance remaining for that equipment. So to keep a clear audit trail in AMT, we do separate this into a separate section. We don't just lump this in with your costs, because then you lose visibility on what are your real costs, your actual, I want to call it cash costs, but there is depreciation in there, so it's not quite cash costs, but it is your normal P&L costs versus your adjustments. And really, these adjustments are all about smoothing. It's about smoothing your costs against your revenue, or better alignment, and it's also done to achieve a more accurate asset valuation. So in this case here, we've got major components of income coming in of 7,294. So you probably can't read it, but that's what I'm circling. That same number then, so that's a revenue getting in. You had no cost on your components. So that is then transferred out of your P&L as a cost on your P&L and credits your provision account for that 7,294. And then the other thing that happens is when you do incur a major component, i.e. a $60,000 cost for a component, that is shown as a real cost, but then it's credited and your provision account is debited for it. So essentially the provision account is paying for it. So that's how the mechanism works in AMT. We'll be coming back to this a couple of times, but that's the base structure. From an asset valuation perspective, I've just overlaid the first line of this report with some numbers in red, which would be sort of typically what it would look like if you're following the provisioning approach. And what we have is we have parent cost and accumulated depreciation and written down value. So this is your normal asset cost. It's the standard depreciation. It's written down value. But then we also have the CBD. So the CBD is the component provision. It's an acronym in AMT for the component provision. So in this case, you've got 300,000 set aside for your components. So the last three columns give you an aggregated total where the asset cost 2 million. You've actually got effectively in depreciation 900,000, being 600,000 of your normal depreciation and 300,000 for your CBD or your component provision. Sometimes that's called component depreciation. So CBD stands for component-based depreciation. So again, this could be a repair reserve, it could be a maintenance accrual. Whatever it's termed though, it's sitting as a credit on your balance sheet. And it's an amount that if you were to sell the equipment today, would be something that would be credited off the asset value in your books of that asset. So that's why we show the aggregated amount. So it's really sitting in your books at 1.1 million. In your asset register, it's 1.4 million, but you've got this further 300,000 of component provision. So your net book value is 1.1 million. So that's what you've got. But the question is 300,000 the right number? So this is a second report that does an analysis of that provision. And it first of all calculates what should be your provision. So if we just take the top line of this, we've got your engine on a haul truck. It's got an expected life of 19,000 hours and a projected cost of 186,000. So it's got a cost rate of $9.79 an hour. It's currently got 7,500 hours on it. So that's the life of that component since it was last changed out. So you should have 73,000 sitting in your provision. In this example, we've got $1, so we're short of 73,000. Probably the line below is a better example. We've got 22,000. We require $22,913. We've actually got 26,000. So we've got an excess provision of 3,000. And that's really what I sort of meant earlier when I was saying you sort of look at this as a bit of an overs and unders or swings and roundabouts, and you're more looking at the aggregated total. So there's two aspects here. The one is we do record what is your actual balance, and then the second aspect is we're comparing that to what it should be. So as your costs change, your projected costs, and as your expected life change, so if you went and said, actually we're not going to get 19,000 hours out of our engines on that fleet, we're only going to get 16,000 hours, that would immediately, by the user changing their strategy, that would immediately recalculate your rate for that component, come up with a higher provision required, and that would be compared with your actual CBD. So making a change like that, of saying we're going to change our strategy, has an immediate ripple on to, well, how much provision is required. And that really highlights probably the main difference between the provisioning approach and the component capitalization approach. Is the provision approach is always focused on how much should I have for that future repair, for that next repair. So the focus is on making sure that when you come to do that next repair, you've got the right amount of money to pay for that next component. While the capitalization approach is saying, no, if my last engine cost me $150,000, regardless of what I think the next one's going to cost, I'm going to depreciate $150,000, because you can only depreciate the real cost of an asset. That last engine that was put in being $150,000, and that's really the theoretical debate that takes place. Maybe not theoretical, but the debate that takes place between provisioning versus the capitalization approach. Okay, so in summary, the provisioning approach, it's very easy to do. It doesn't actually require a lot of administration or maintenance. It can generally be set up that it runs automatically, because the revenue you're getting in, part of that can be automated to be put to the provision account. Your component cost can be automated to be charged to that provision account. The main manual thing is just to keep an eye on it. Is it staying in sync? And if you're achieving your targets on your maintenance, then it will. It's only if you're getting less component life or more component life, or the cost of repair is significantly different. And that is a trend. It's not just a one-off. That's what will cause you to say, hang on, we need to adjust our provision account. But if you're on track with your maintenance, there shouldn't be too much manual adjustment of your provision account. So that's component provisioning. The component capitalization is, as the title describes, it is capitalizing each component. So instead of looking at a whole truck that might cost $3 million as one asset, you're actually splitting it apart at the point of registering it in your asset register. And you do this within AMT. You register the base truck, the parent asset as we call it, for in this example, 2.58 million. The engine gets registered as its own child asset for 200,000, the transmission for 60, and so on, so that the aggregated asset is still 3 million. But you've actually registered, in this example, 5 assets making up that 3 million. And you treat each asset independently. The base haul truck would be depreciated over its life with a residual value. The engine of 200,000, well, that would be depreciated maybe over 18,000 hours, its life. The transmission maybe over 12,000 hours. Each one has its own depreciation charge against it. When a changeout occurs, say a transmission changeout takes place, you then physically will dispose of that transmission that is in the truck, i.e. you're taking a transmission out. So you dispose of it. You go through the standard processes to dispose of an asset from your asset register. You reverse its cost, you reverse its accumulated depreciation, you record a profit or loss on the disposal of that asset, and then the cost of the new transmission that you put into the truck, that gets capitalized as a new asset, and then with its own depreciation schedule moving forward. So it's a very different approach. It is all around treating each component as its own asset, and it's based on historical. Nothing about the future cost. If the last engine you put in cost you 200,000, that's what you're depreciating. Even though you might have a case where the supplier says the next engines are going to be 260,000, you still are only depreciating the 200,000. This method does create a lot of challenges to apply practically. It's sort of easy to talk about it at this level, but actually applying it practically requires a lot of administration, because every time there's a component changeout, you've got to do a minimum of 3 journals. You've got to reverse the asset, reverse the accumulated depreciation. The balance of that gives you your profit and loss, and then the third thing is you've got to capitalize the new asset. But there's a lot of sort of tricky aspects that go into this. If you have a warranty failure, so you do have an engine changeout, a new engine gets put in, but you only have to pay $2,000 for the new engine because it was picked up by warranty. You're only allowed by accounting standards to capitalize your actual cost. So is that at 2,000? Similarly with partial rebuilds and those sort of things, there gets to be quite a bit of grey area. So it is an approach that AMT supports. We have a full asset register that can cater for your parent and your component assets. We do have some very large mining contractors that are applying it, but they would also be the first to say that it's from an administration point of view, it is a very costly approach. So it's I guess the message from us is it's not something to be undertaken lightly, but AMT does support it. So so this is pretty much just summarizing what I've just said. I think there is a benefit from the tax perspective. That seems to be the main driver behind people following this approach. From the tax perspective, you might get a more aggressive depreciation in your first couple of years. Okay, automated routines. AMT has a number of AMT AMT has, sorry, I've just got a little thing on my speaker. I'm not sure if you guys can hear that. AMT has a number of automated routines to streamline certain processes. And I'll just go through the main 4 of those that relate to the provisioning. Some relate to both, but it's the first one is process plant invoices. So AMT, you can set up your plant rates with an AMT for a project, and we saw a screenshot of that right at the beginning, where you might have a plant rate of $100 an hour being made up of depreciation and finance and maintenance, etc. But on a monthly basis, AMT can calculate what the invoicing should be for each asset. For each project, because in a month it could actually be assigned to multiple projects. So AMT will automatically look at the utilization of the asset and calculate the plant invoice and generate an invoice record within AMT. That record the administrator can open up and can edit various things, can override certain assumptions and can change it, but the initial calculation and generating of that invoice is an automated process. You can either follow that approach, or you can actually import your invoicing from an external system. So if you're doing your invoicing for your equipment in an accounting system or another system, we can just import the net result. So that's the first point, is to get those invoices into AMT. You can either have AMT generate those invoices each month, or you can import those. The second automated routine is around processing capital and other operating costs. So AMT is designed to bring in work orders as your actual cost records. And generally those work orders are maintenance related. It's doing services, general repairs, major components. But as we saw earlier, you want to bring in all your costs into AMT that match or align to your plant revenue. So you have then the challenge around some of your capital costs, your finance, even depreciation, and some of those other operating costs. If you've got a recovery of plant group overheads, how are you going to get those costs into AMT by equipment by month? Now, there are some methods where we can do an extract from those from the accounting system and apportion it to each asset and bring it in. But an alternative approach is you can set AMT to actually generate the transaction, the work order, for those costs each month. And AMT will assume that the cost that you've set up in your strategy task, the projected cost, is the cost for that month. So there are 2 reasons why you would do this. The one is you actually want AMT to be the system that is generating the transaction. So AMT can be your asset register. It can generate your depreciation each month, whether it's on a fixed monthly basis that you're doing your depreciation, or if your depreciation is a rate per hour, engine hour, say. AMT can look at the hours in the month, look at what your depreciation rate is, calculate your depreciation charge, and generate a work order as the cost record in AMT for that depreciation. So the first is AMT can be the system that is generating that transaction, and that generally applies specifically to depreciation, where AMT is the depreciation or the asset register. And then the second is really from that practical perspective of being able to get other operating costs. If you've built into your plant rate $1.50 an hour to recover plant group overheads, maybe you just want AMT to process a cost of $1.50 an hour as your assumed actual cost for plant group overheads, and that would generate a work order. So it really means then that you are comparing your sort of apples with apples when you're looking at your revenue versus your costs. So within AMT, at the strategy task level, there's a flag called Enable User Work Order Settlement Creation. So you decide whether you want to enable this routine with an AMT, and you decide by strategy task, by equipment. And so first of all, that flag needs to be checked at the strategy task. And then secondly, it is a user-initiated routine where each month your administrator would say, right, we want to process these transactions or generate these work orders, and you can nominate the date of the work order as well. Generally, it'll be the middle of the month that you'll sort of have it dated. Maybe it's the first of the month or the last of the month, but you have control. The system's not going to at month end automatically run this. Generally, the administrator would check that you've got the correct utilization entered into AMT, so that when you do run this routine, you know that you're calculating everything accurately. The third area is your component depreciation or provisioning. So this is to automate the process where you've charged in your plant revenue $10 an hour for depreciation or for your major components. So you've got $10 an hour revenue coming in for your major components, and you want to transfer that $10 an hour to your provision account. AMT's got an automated routine that will look at what the revenue is for that category and then automatically create a journal with an AMT to credit your P&L and debit your provision account. So that's a configuration setting within AMT, and each month AMT will automatically generate that transaction. So it really saves your administrator from each month having to manually or sort of run a report to calculate what that revenue is, and then buy equipment, go and enter a journal to transfer that revenue essentially to your provision account. And in a very similar vein, the opposite side of that is when you have a component change out, we can have a system configuration setting that says each time a component is performed and you've got your actual cost sitting in a work order for a transmission change out, automatically create a journal to credit the P&L for that amount and charge that to your provision account. So that's what I was meaning by earlier when I said the system can be set up to run automatically with this provisioning logic, and it's only really the exception management that you are sort of monitoring, and not having to do the hundreds and thousands of individual journals and transactions each month for all of the different components. So this diagram tries to really summarize those four automated routines that we've just spoken about. On the left we have our balance sheet with the provision account, and on the right our profit and loss statement. So first of all, starting with the profit and loss, your income section. You want to have all of your income, plant revenue coming into AMT, and you've either got the option to import that, which is the sort of indicated by the shaded grey eye, or item flag 1 is the first of those automated routines that we had a look at, where AMT can automatically generate those monthly plant invoices by equipment, by project, and get that invoicing transaction, as it were, into AMT. So you've got the option to either have AMT generated or to import it. The second one is your costs. So we would be importing generally all your maintenance costs from an accounting system. But then you do have your other cost categories, your depreciation, your other operating costs, your finance, and you can either be importing those, or you can have that second automated routine where AMT will automatically generate the work order cost for those items. So the objective of 1 and 2 coming out of that is you should have 100% of your plant revenue aligned with 100% of your plant costs. So this is your, again, what I call your real costs, your cash costs, your sort of actual costs. So if you didn't do any provisioning or any component capitalization, that would be your P&L. You'd have your income, you'd have your costs, and a net profit. The next two automated routines are really aligned around maintaining this provision account. The first is your monthly, call it component depreciation or transfer of your component revenue to your provision account. And that's that first automated routine. And that's really just picking up the revenue that you receive from this area, your major components, and putting the identical amount in as in a journal, debiting your P&L, and crediting your provision account. And then the second one is looking at any costs that you've incurred in your major components and automatically crediting your P&L and debiting your provision account. So again, with 3 and 4 operating, you shouldn't have to do any day-to-day journals to maintain that provision account. It's really at a month end, you're looking at the aggregated picture and saying, does it align? Is our provision account still accurate or within a materiality sort of tolerance that you set? And if it's not, then you are doing specific sort of journals. But at that point, you're probably looking at why it's not as well, because it does mean that your costs are being incurred aren't in line with your income structure, with your plant rates. Okay, now this area does get a little bit complex, but again, it's more about understanding the principles. So AMT has the ability to forecast your P&L. So what we've talked about up until now is really looking at having your actuals recorded, your actual revenue, your actual costs, what should be in your provision account right now. But AMT's got the ability to forecast your P&L, forecast your revenue, forecast what your costs are going to be. But there are a couple of issues that are raised. The main one is around if you've got a future project, but it's only got a probability of, say, 30% assigned to it, then what should we forecast for the revenue and the costs? We want to ensure that there's apples with apples comparisons. We don't want to factor 30% of your revenue, but still assume that you're incurring 100% of your costs. And we also don't want to just apply 30% to your cost, as then the audit trail in AMT, someone's going to look at an engine change out that normally costs $100,000 and see $30,000 forecast for an engine change out. And that's going to cause a lot of confusion as well. So just before we get into how we handle that, I'll quickly just cover, for each project you can set up what your probability is, and that's this figure here. So this little screenshot is an extract from where you set up your plant rate for a project for a specific equipment. So there is a field here that defines what the probability is and the expected utilization. Now the context of this is a future project. Now where you don't have a future project, let's say you've got a machine and it's under a project now, but it runs out in 3 months' time and there's nothing assigned to it thereafter. What probability do we assume that you are going to find a project for that equipment? And so in the base details section in AMT, where you set up the equipment, you have the ability to put a default probability for the next 6 months and a default probability for greater than 6 months from now. And the logic behind that is saying, if you've got a machine that isn't assigned to a project in the next 6 months, it's unlikely you are going to assign it, or you're going to assign it for any sort of, there's much higher risk it's not going to be assigned. Meaning if you don't know of any potential project for it now, it means within 6 months you've got to find a potential project, secure a contract, get the machine to site, and actually start operating it. So your odds of getting it to a project are a lot less. So you'd have a much lower probability for that period, maybe 20% in this example. However, greater than 6 months, your probability should be a lot higher, because by definition you're electing not to sell the equipment or not to dispose of it. So management must be fairly confident that you're going to be able to hire it out. So you can assign a higher probability to it. And that's really just the reason why we have these two different probabilities. Okay, so how do we handle this probability in our forecasting? The approach that we use is that we apply that probability to the forecast utilization. So if the equipment is forecasted to do, in fact in this example here, if it's got a probability of a future project of 60% and expected utilization of 5,000 hours, then we don't assign 60% of the revenue and 60% of the cost. We actually say 60% of the utilization. So we assume it's going to do 3,000 hours. Correspondingly, the revenue and the cost will then be that much lower, because we're only scheduling the maintenance for 3,000 hours, and we're only scheduling the revenue for that 3,000 hour period. We do apportion monthly based revenue items to achieve 60% of a fixed monthly cost. But so that's the main approach. So the important thing though is when people change the probability of 60% to 80%, it's having quite a big impact on AMT, on the future forecasting, because it is dynamically going back and reforecasting or resetting the expected utilization for that equipment, and subsequently reforecasting all of your costs based on that. So it's reforecasting all of your maintenance schedules based on that. So it has quite a big impact. So it's not something that should be fiddled around with lightly, but it does mean that you're always looking at your forecasted P&L, knowing that there's a close alignment between your forecasted revenue and your forecasted costs. You're not getting that disconnect situation happening. There's just a couple of points for this logic to apply that I probably won't go through now, but that's the main sort of methodology that is applied. Now, this only applies to future projects. So if there's a current project, if the machine's in progress right now, so it's got a start date in the past for the project schedule, but it's got an end date in the future, meaning it's a current project that the machine's in, then even if someone's put 50% or 60%, AMT assumes it's 100%. If it's there on the project right now, it's a current project, then it's a sort of case of you can't be half pregnant. It's either in the project or it's not in the project. And if it's set up in the project, then even if people haven't corrected the probability, AMT assumes it's 100%. So this high probability and utilization assumption has no impact on current projects. The other reason for doing that is current projects, there are guys who are maintaining the equipment now for those projects. They've got their component change out schedules, they've got their assumed utilization set up. They don't want suddenly all these things changing because someone's gone and entered a different probability. So for the current projects, there is no impact of this probability. So it does just provide a level of protection as well around the current projects. It's only future projects where you are signing that it's possible or it's probable, and you're assigning these different probabilities. So it's only the things in the future that this logic is being applied to. The other thing that AMT does is it does forecast what we call your CBD over and under adjustments. Now this is your what I referred to earlier as your manual adjustments. If you're doing the provisioning, by and large the system will maintain itself, except if you get out of sync with your maintenance. If you're not complying with your maintenance schedules, or the basis for your rates isn't supported by your maintenance, then you will get out of sync. You will get to a point where your the money that you've accumulated for a component isn't enough to pay for the component. So you do have to do those manual adjustments. So AMT forecasts what those manual adjustments are going to be. It looks at your rates and it looks at your costs that you're forecasting, and where it sees a disconnect, it'll forecast another line on your P&L for your over and under adjustments that we think you are going to need to do. So it's actually quite a good indicator of whether or not your maintenance schedule is really in line with your plant rates. So where you've got an example where let's just go through this example here rather than create a new one. So if we've got equipment that's forecast to do 5,000 hours a year, and the engine set up with a frequency of 15,000 hours and a cost of 150,000, at that time its plant rate is calculated to be $10 an hour. So you've got your plant rate, it's been set, it's $10 an hour, you're locked in, you can't change that. But if the engine cost is changed, the supplier comes and there's a new engine or a price increase, and the cost is now 180,000, but you can't change your plant rate, then really what we're saying is your effective plant rate on your maintenance schedules is going to be a lot higher. So if you get to a point where you've done 5,000 hours, then, or in a typical year of 5,000 hours, you're going to incur an average cost of 60,000. That's your sort of cost rate, as it were. But your revenue you're getting in is only 50,000. So you've got an annual variance or disconnect between your revenue and your expected average annual cost of $10,000, which comes up with a monthly variance of $833. That 833 will be highlighted as a separate line on your forecast P&L under that heading of forecast CBD over and under. So again, it is quite a powerful number to be looking at, because it gives you a good indicator as to whether your plant rates are in line with your maintenance schedules. Escalation is a typical thing that causes this to become a real issue. If there's no provision to escalate your plant rates, but over a period of a couple of years you get 10-15% escalation applying from your suppliers, then yes, you start to see quite a significant variance appearing. Okay, so how does this come out in your P&L? So this is our P&L again, same structure as what we saw before, but this is your forecast P&L. So the first section, your forecast revenue, that's really just looking at your plant rates, expected utilization, and forecasting what the revenue is going to be. Albeit that utilization could be factored lower because of your sort of probabilities of future projects being applied. Similarly, you've got your forecast of your costs, and this is just your standard life cycle costing in AMT, looking at those strategy tasks and forecasting out your costs. So nothing new in that area of functionality. But it's this area here where we do see these elements coming into play. So these are our journal adjustments. So the first one, your component depreciation. You'll see that this number, 5941, exactly correlates to your major component revenue, 5941 up here. So that's that first journal or automated journal, automated routine number 3 that we were looking at before, where the revenue you're getting in is journalized out. The second point to highlight is, in this month here, you've got a capitalized component being transferred out of 143,000. So this line here is your cost being incurred for your major components. And it's 0, 0 all the way through, and then bam, you've got a big cost here. That cost is journalized out and charged effectively to the provision account. So those are those journals 3 and 4 that we looked at earlier. But this line below, this forecast CBD under and over, this is what is picking up the difference between your base rate that your maintenance is being forecast to run at versus your revenue. So in this example, it's saying that your revenue is going to be lower than your future cost, that you're going to need to be topping up your provision account by $409 or $400 on average each month. So again, it's just highlighting that it's probably not material with these numbers, but your plant rates are slightly behind what your cost structure or your maintenance regime is. Okay, the last point that we touched on earlier is really it's important to decide which configuration of AMT is suited for you. And this really comes back to that component management section. It's because it does impact how you set up AMT, some of the automated routines that you run. So deciding whether you're going to be following the provisioning approach or you're following the component capitalization approach, or neither, is the third option, is really important to decide upfront, because again, that's how the training materials, the data setup, everything will be structured on that basis. I did mention earlier we haven't really gone through the component capitalization. There's another module of AMT around the asset ledger, which is really what we would be covering in quite a bit more detail in the training in these sort of sessions. If we're following the component capitalization approach, it does get into a lot more detail about how we actually account for the components, the child components, how we depreciate them, how we set up the accounts with an AMT, and how we sort of manage that on a day-to-day basis. Again, this presentation's more been aligned around the component provisioning approach. Okay, thank you. I think that's the end of this presentation. Hopefully it's given you an overview or an understanding of the key principles behind the Contractors module. The next step from here would be to actually go through an actual demo of AMT or a more structured training program, and there is a Word document around the sort of procedures around the Contractors module, and that would really be the next step now, is to go through those. Okay, thank you very much.